Hello, everybody. Welcome to PFA's first quarter halftime report. Today is March 4th. My name is Sam Chaplin. We're here to give you a market update roughly halfway through the quarter. Joined by our Chief Investment Officer and Advisor and Founder, James Bradley. And how are you doing today, Jen?
Doing just fine. Yeah, you'll notice we're just a little bit later than we usually are on the halftime report, but I think that's fortuitous this quarter. We've got a lot more to talk about now than we might have just had a few weeks ago. So eager to get into it.
Yeah, I see this as kind of halfway between our two written commentaries, too, which come out a little bit after the quarter ends. So from that perspective, we are right on time. So let's jump into it, try to keep it short and informational for you. First, it's going to jump into the US economy. Obviously, something that everybody is worried about all the time. But if you look at this chart, you're going to see that a lot of the recession indicators here as of January were largely in positive territory outside of job sentiment there. Actually, most things looking either in a caution or an expansion territory and getting an overall signal here of expansion, which is good to see. And that's actually showing improvement versus December and November. You could also take a look at this layout versus recessions of the past. See, it compares very favorably there. So with this information, we would say, barring any, you know, if there are not any major shocks that we're unaware of happening this year, and I understand the word "if" is doing a lot of heavy lifting in that sentence, that we don't expect any recession in the coming year. I will say, as one caveat, we'll expect the February data to look a little bit worse. We've seen some deceleration in retail sales, housing permits, as well as some increases in jobless claims. So I would be surprised to see those move into caution territory. The other thing I wanted to give people a heads up on is that it's very possible that we get a negative GDP report for this quarter, the first quarter. And that might generate some scary headlines. But the reason for that is kind of interesting, a little bit technical. But if you can stick with me, the way you calculate GDP is to add up all the spending done by consumers and the government and businesses, and then you subtract out what was imported. So if you take what all Americans spent minus what they spent on imports, you get what Americans spent on US products, gross domestic product. And with all these tariffs going on, people are trying to front run these tariffs by importing a lot of goods before those tariffs go into effect. So that actually becomes a subtraction out of GDP, which could push us into negative territory, but is not necessarily a sign of bad things to come. It's just people trying to front run those tariffs and bringing GDP down through the math. So I did want to mention that. We talk about the economy, how it feeds into markets. One of the biggest vectors, the way that happens is through interest rates, which, at least at the short end, are controlled by the Federal Reserve. They are stuck to the dual mandate we've been talking about for a long time. They want to keep prices stable while keeping the economy at full employment, showing some improvement here, even recently on the top chart here, which is core inflation down to 2.65%. They're hoping to get that down to 2%, projecting it'll take likely till 2027 to make that happen. But they are also forecasting unemployment to remain around 4%, maybe up to 4.3% through that period. So slow progress on inflation while maintaining employment around where it is now is the forecast at the moment. So Jim's going to talk a little bit about how that feeds into expectations for interest rates going forward.
When you look at the scenario that you're just looking at there and the numbers that you're looking at, there a lot of justification for the Fed taking a very cautious approach to making any moves up or down in the Fed funds rate. Just a few short weeks ago, it was pretty common as an expectation that the Fed would probably not do a whole lot of rate cutting this year, probability of 1 to 2 rate cuts. But now looking at this slide, you're going to see that the most common assumption out there right now, the highest percentage allocated to a position is 44% going toward 3 or more cuts in 2025. So this is, a change of pace and reflective of concerns that Sam also talked about, like things that could indicate that while we still are in a relatively strong economy, that a slowdown could very well be in place, that the Fed could be called upon to resolve. Obviously, there's still the wild card of where inflation goes, and if some of the more recently and today and yesterday kind of initiated um, tariffs and that type of thing start to weigh in on inflationary concerns, that could move us back to where we were. It's kind of cruel reality, but folks who are waiting for interest rates to come down for things like house purchases and that type of thing had some degree of optimism that they were looking at when they saw the Fed start cutting rates in late 2024. And there were three total rate cuts, totaling 1%. But it proved to be short lived when, over that time period, mortgage rates actually rose from a low of about 5.89% in mid September up to over 7% again in the middle of January. Good news is they've been creeping back down again. That is also kind of in lockstep with Treasury yields that has decreased. The 10-year Treasury seemed destined back earlier in the year to want to try to test and maybe even break the 5% level. A lot of economists looked at that as being a very bad omen. Now it's toying with actually the other direction, toying with the 4% level, down in the low fours as of when we're talking right now. This is welcome news for bond investors. It's welcome news for debt holders, welcome news for people who might be looking to refinance in the future. Those mortgage rates may have a little bit of downward pressure still to work out, but a cautious approach is certainly warranted, as if we do see a reignition of inflation, that could reverse this downward trend in rates. Sam, over to you with a look at these valuations that are keep on coming up on our radar.
Yeah, valuation concerns, particularly in the S&P 500. Looking at this chart here, you can show, by about like 5 out of 6 measures here, the S&P 500 is looking overvalued relative to its historic averages. You could say, we're going through this AI revolution. There's a lot of things going on that could justify higher valuations. But we want to, reassert, as we do quite often, that the S&P 500 is not the entire stock market. It is not the entire investable opportunity. It's actually 40% in about 10 stocks. So when we look outside of that area and we look at valuation concerns more broadly, or valuations more broadly, rather, you'll see that a lot of the valuation concerns are concentrated in that large growth area where those 10 largest stocks are. So this is a Morningstar chart looking at their analysis, where they think valuations are high, where they think they're low. And you can see here on the left-hand side, smaller companies, not quite as highly valued, even undervalued in many cases, as well as the value side of this chart, as we've been focused on for a while. And then you broaden out geographically. You can see that US and Canada, Australia, India looking a little overvalued, areas like China, Russia, Europe, Brazil, Mexico looking actually undervalued. So, like just because the S&P 500 is not doing so well these last few days doesn't mean everything's not doing well. And this is actually being reflected. If we go to the next chart here and look at the stock market returns over the past month, you'll see that a lot of the losses have been in those areas that were looking pretty pricey. They're a little frothy. So that is the double-edged sword of momentum. When stocks are going up, they get those high valuations and they continue running. That's been the case for a while, where the best performers have been some of the most highly valued companies. But when that does turn around, they are the most susceptible to take a haircut. So we've seen that growth side. We've seen the US not doing as well versus the international counterparts. And on this next chart here, you can see that I think this is through, looks like February 24th. US is actually the worst performer internationally. Areas like China, Europe doing better. So that's why we've always liked to have a well-diversified portfolio. It's always tempting to pile into whatever has been doing well recently, but over the long term, you can have strong returns with less risk by having a well-diversified portfolio across geographies, company sizes, asset classes, private markets. So we do think there are still opportunities out there, and just because of the performance the last few days is not necessarily a reason for panic. And that brings us to a next conversation around key risks and key opportunities going forward. I think we're going to do a little good cop, bad cop. Jim was bad cop last quarter, so I'm going to be the bad cop this time. And some of the things that we've already talked about: key risks, stock market valuations, that S&P 500 trading well above its long-term averages, as well as the concentration within that index, means that, company like Nvidia down 15-20% recently can put a lot of pressure on that index to push it lower. And that doesn't necessarily mean the entire economy is doing bad, doesn't mean all equities are doing bad, but is a reflection of a small amount of companies. Escalating trade tensions. Today is the day to talk about that. We have massive tariffs going on against China, Mexico, a lot of the US's biggest trading partners. Lots of uncertainty around how that is going to go, how long they'll be in effect, what the eventual outcome will be. And we expect this to continue creating volatility in the coming months. Inflation concerns, as Jim talked a little bit about as well. I talked earlier about a lot of people pulling forward imports to try to front run those tariffs. That's actually an inflationary process as well. Inflation can be somewhat of a self-fulfilling prophecy. I saw an article recently about concerns that car prices are going to go up $12,000 on average based on these tariffs. So if you can think that you were planning on buying a car in 6 months and you see that report, you say, not doing that, let's buy it today before the prices go up. Now you're pulling forward all that demand and it's more likely to outstrip supply. And that's when you get inflation. So that is a key risk we're looking at as well, adding things like more gold and inflation protected securities to our portfolios, and maintaining that well diversified geographic footprint that we have going within our equities.
Yeah.
Tell us some good news.
Yeah, you bummed us all out. So let me try to throw a little bit of sunshine on us here. It's not the base case for a large cohort of economists, but it seems like in parenthetical terms, they're quite frequently throwing out the idea that there could be some offset to price impacts of these tariffs, price impacts of deportations and or deficit spending and that type of thing through increased productivity that's comes out of the increased proliferation of these AI applications. And we certainly are seeing just a ramping up in an exponential log format line that we would kind of expect to see with a big emerging technology like AI. And 2025 could very well be the place where AI optimism broadens out and cases become more clear. It could breathe new life into mature industries like utilities, which aren't really the biggest growth industries, but really bring down costs. And if they can do that and offset some of the cost impact of what we're seeing there, that could actually end up being a really positive environment for a continuation of economic growth this year. Putting a lot of our wishes on AI there, and like I say, it's not necessarily the base case that it can keep up, but it should have some offsetting characteristics. Another thing is looking at bonds. Even though that 10-year Treasury is going down into the lower fours, that's still relative to more recent numbers. Looking over the last 10, 15, 20 years. Not a bad place. And it's kind of trickled on down to shorter term yields, guaranteed interest yields, high yield bank accounts, and that type of thing. We can get a decent rate of return still on fixed income, but the difference is relative to the beginning of 2022 with low interest rates. We're not nearly as subjected to the risk of correlation between the movements of these bonds with stocks. So if indeed the economy starts to slow, if indeed prices start to cut into consumer demand and that type of thing, and we start to see equity prices reflect that, it could be, again, a relatively good period for those who hold money in bonds, where bonds can actually retake that negative correlation kind of characteristic that they have and offset some of the volatility. So we're relatively optimistic about that. And the last thing that we're kind of optimistic about right now as asset managers is that it's really tough to keep up with, an index that's being driven by 7 to 10 very concentrated stocks when those concentrated stocks are doing very well. But when we hit bumps in the road, that's where those very expensive valuations that they're showing off right now become something that it's more capable for an active manager to actually sidestep and to focus away from. So while the S&P 500 is, arguably expensive, as Sam showed in the slide a few ones back, if you look at that's again kind of about 40% representative of 10 companies. If we just broke out the valuations of all 500 stocks into equal parts, so 0.2% each of the S&P 500, and averaged out their price to earnings ratio, it's right around the historical norm of 16 to 17 times. And that's, again, something where you've got the opportunity, and we certainly have taken advantage of it over the past month, to take advantage of some of this value that's still out there to either help you to kind of catch up with the rest of the market as the remaining parts of the economy take advantage of things like AI, or to have it be a little bit easier of a ride along the way when things like tariff policy and that type of thing become, big market shakers, something that can kind of give you a little bit of a smoother ride. So with all those things in place, we see some dark clouds, but we've also got some optimism in certain areas.
So the last thing we want to talk about here, we always like to fold in something about, lots of questions we're getting, and very understandably recently, is people trying to reconcile a lot of chaos happening in the political sphere, as well as a ton of uncertainty with the relative calm within markets. And it is a difficult thing to reconcile, even for us as asset managers. But we do need to point out a couple facts here that are somewhat uncomfortable, but I do think important. So you don't have to like them. But when it comes to making market decisions, you have to respect them. One of those is right here on the next slide, looking at the share of personal spending by income bracket, showing the top 10% now counting for over 50% of US spending, with even, the bottom 60% below 20% of US spending now. So, people are saying, like, why was what I'm feeling on the ground not nearly as good as what's happening in markets? And this is a big part of it here. So spending has actually been decreasing for a huge, substantial part of the economy, even up to the 90% level. But then that last 10% has picked up their spending and has kept the US in a largely positive spending trajectory. So that explains some of it going on the spending side. And then how does that feed into markets? Well, if we look at markets and who owns the market, you got to be able to read the room here, know who your audience is when you're making these decisions. The top 1% now own about 50% of the US stock market. So you can think about the trades happening day to day, the decision making behind those. 50% of those decisions are based on the outlook for that top 1%. You expand that a little bit further to look at, all right, how much does the top 10%, the wealthiest Americans, own of the stock market? That number is 93%. So 93% of the stock market is owned by the 10% wealthiest Americans. They are the ones largely driving the decision making on the markets, and setting the direction. And to that cohort, things like tax cuts, deregulation, lower energy costs through drilling, privatizing some areas of government, automation through AI and robotics. These are all things that are providing a huge incentive to invest and create opportunities for this subsect of the economy. So while it's not comfortable, don't love it, wish it was the stock market was a better representation of the economy and the average person in the economy, that is really not the case. So it's something that we have to keep in mind, that your outlook for yourself does not necessarily feed into the outlook for the market as much as we might think. So with that, like, somewhat depressing note, but I think important one, we are going to leave you there for this quarter, and we will see you next quarter.
See you next quarter. Everybody have a great spring.